Hey everyone, in this trade review video, we're going to talk about my trade in POT and all of the adjustments I made as the position went against me. One of the coolest things about premium selling is that we can continually chip away at our cost basis to keep a losing trade alive and eventually turn it into a winning trade or even just get out at break even. And that's actually what I did with this trade because, to be honest, this trade went against me from the very start. So this video isn't going to be about me showing you some big profit I made or anything like that, because the reality is with any trading strategy, positions will go against you every now and then. And that's one of the trickiest aspects about successful trading, is just knowing when and how to adjust a bad position. So what you're looking at here are just all of the trade fills. So you can see the original position here where we sold the 20 straddle, which just means we sold the 20 strike call and put. And then you can see all the adjustments. And I'm actually just going to show you this on the chart so it's much easier to follow. So here's a chart, and let's just walk through the trade and each adjustment that I made. So on December 1st, implied volatility was high, options were liquid, stock was liquid, all of that's great. So we sold the 20 straddle to take advantage of that. And I sold this for $1.93. This puts our break even at $21.93 on the upside and $18.07 on the downside. Then you can see things went a little bit sour. I mean, the timing couldn't have possibly been worse for us to sell this straddle. And that's not something I did wrong necessarily, because of course we can't predict the price, but I just wanted to point that out. Okay, so we're in this position and the stock is going lower. At this point, we're not really worried about the call anymore. We're just worried about the put. My break even is still at $18.07, and the stock is trading well below that, around $15.50. At this point, my job is to simply get my break even down. Doing so would improve our chances at turning this losing trade into a winning trade. So what I decided to do was just let the 20 strike put expire in the money and turn into stock. So now I'm long 2,500 shares of stock at $20. And my break even is at $18.07. So now what I needed to do was sell some calls against my stock in a further expiration to collect more credit and improve my break even. But the question is, what call do I sell? And I think this was a simple decision for me because I didn't really care about maintaining a large profit potential on this trade anymore. I would have been more than happy to just get back to even. So I wanted to sell a call for a large credit that gave me the best chance at getting out at break even. Here's a look at what each option was trading for. The 17 call was at 72 cents, the 18 call was at 41 cents, and so on. But here's the thing, we needed to sell a call that would put our break even below the strike price. And I know that may have sounded confusing, but think of it this way. If we were to sell the 17 call for 72 cents, our new break even would be $18.07 minus 72, which is $17.35. But if we're short the 17 call, that means the best case scenario that we could close the position for is $17. And that would leave us with a loss of 35 cents, and we don't really want that. So let's check out our other options. If we were to sell the 18 call, we would be able to chip off 41 cents off of our break even. So our new break even would be $17.66. And this is perfect because it leaves us a profit potential of 34 cents per share if the stock is anywhere above $18. So that's the adjustment I made. I sold the 18 call for 41 cents. Now I'm long stock and short the 18 call, and my cost basis is $17.66. And after I made this last adjustment, the stock continued to test my patience. It traded all the way down to $14.64. But you have to be patient and not over adjust. So now some time went by, and I was considering making another adjustment because I still wasn't back to break even. What I planned to do was let the 18 call expire worthless, and then the idea was that I would just sell the 17 call in April and hopefully do this for greater than 66 cents, because that would put my break even below $17. But fortunately, I didn't have to do that because the stock finally started to show some strength. It rallied above 18, and I could have tried to hold to expiration to get out at max profit of 34 cents per share, but thinking back to how much grief this position gave me, I decided to just close the position at an average price of about $17.61. So I lost 5 cents on the trade. And this was awesome because at one point I was down at least a few dollars per share on the trade. And that's what's really cool about trading options in this way, is that we can always improve our break even without adding any risk. If you think about it, the only way to improve your break even when trading stock is to just buy more stock, and it would bring your average down a little bit. But the problem with this is that you add more risk by doing this. With options, we are always able to improve our cost, but without adding any risk or size to the position. So, alright guys, that was the trade, and I hope this video helps you understand a little bit of my thought process as I'm adjusting my trades. Let me know if you have any questions, and I'll see you in the next video.